Well, good morning, Tony Virtue speaking, Virtue and Partners with our regular monthly update. A little bit earlier this month, a bit of volatility out there, so I thought we'd talk about that as we need to. I think the short version was the China-US matter still drags on. I mean, there's a view that there's a bit of shadow boxing going on there and suits both parties to keep things going. The Chinese had retaliated briefly by dropping the yuan down below 7. The net effect of that was that there was some volatility last week. It does seem to have stabilised as we speak, but the trade war still trugs on. If you're an international company trading from China, you can of course just move your manufacturing elsewhere, and that's exactly what's happened with there. The net effect of that has been that a number of countries have dropped their interest rates again, notably New Zealand and India. Here we've kept our rates steady at 1%, but the Reserve Bank has indicated now that they may try quote-unquote unusual tactics. Now, what does that mean? It's a euphemism for quantitative easing, which has been used in America, used in Europe, where effectively a national government via its Reserve Bank buys the bonds of publicly listed banks. The net effect of that is to increase the value of those bonds, reduce the yields, and in doing so, that creates liquidity in the market. So the issue we have now is that it really wouldn't matter if you drop rates much further. If people can't borrow money for a mortgage in the mid-threes, they're not going to at a lower rate. Conversely, those of you as retirees watching today know just how low cash rates are and the fact that we're moving up the risk curve to get some level of return for you. The effect of these lower interest rates is beginning to bite in the property market, and we can see auction rates in Sydney and Melbourne have improved. It's a leading indicator. The volume should come in spring, and the net effect of that should be if we get a bounce in property prices, people feel a bit happier, more likely to spend money, etc. there. The other thing I'm noticing in the city, those of you working in the city can see that they're close now to getting the trains working, and we've got a little tram going to be going up and down George Street. WestConnex is opening as well. This should also help on the transport side, and that effect of that should be people saving time coming to work, should increase the value of properties a little bit further outside of the city. So they're net positives. We're now into the earnings season. CBA first came off the rank last week, retained their dividends, and we're seeing that across the market. So while we're not expecting particularly exciting year-end results, it is not easy out there to grow growth. The dividends are holding, and we're expecting a record amount of dividends for the season. That will flow through into your income streams, particularly for those of you in the retirement phase. So it is a bit of a grind out there, and I don't think markets are expecting too much, and so it's probably already in the share price of a lot of these companies. Finally, those of you in the retirement phase, the government has loosened up some of the rules for buying annuities. That means now that only 60% of an annuity will be included in the asset test. So we'll be working closely with those of you affected, those of you who are very close to getting that health card and your income is well below the income tests. We'll be looking to replace some of the fixed interest component of your allocated pension with an annuity, and the net effect of that will be you might just get the health card there. So look, kids, you get used to the highs and lows of life. It's never been an easy day in this job, and markets I think will be volatile for the next few months. It goes with the territory. Look for something a little more sort of flexible as far as our own RBA goes. As far as this quantitative easing, it's something that has been used effectively around the world. That said, it's very, very unlikely that we'll be increasing interest rates anytime soon. Those of you who are able to, it's not a bad time to buy property, buy shares. They're all going to be positively geared, and so as always, a bit of caution. But if you can see beyond the immediate and look longer term, probably some opportunities out there. So that's up for this month. Tony Virtue, When Experience Pays.